Welcome to today's discussion on CRISIL's Rating Roundup, which is primarily a semi-annual publication which analyzes CRISIL's rating action over the last 6 months. And it tries to link that with the economic underpinnings and the business factors in the economy. The credit quality trends saw two distinct tracks in the last 6 months. One, where the firms were linked to investment cycles and high debt on books saw downward trajectory, whereas the upward trajectory was seen in firms which are linked to consumption, export oriented, and firms with very low leverage.
So the debt weighted credit ratio, which is the ratio of debt on balance sheets of firms upgraded to that of firms downgraded, came in at 0.27 times, and this is the lowest that we have seen in nearly 3 years, and this contrasts with 0.62 times that we have seen in the previous fiscal 2014-15. The primary driver for this low ratio is very clearly the large debt which is there on the balance sheets of companies which is there in the metals sector, infrastructure sector, and commodity linked space. However, does it mean that it is all gloom and doom for all the companies in terms of credit quality? Clearly the answer is no. We have seen there are firms in our portfolio of about 14,000 odd companies where we have seen uptick in the credit quality, and specifically coming from sectors which are export linked, which are consumption linked, and for those firms which have low leverage. In all, in first half of 2015-16, we've seen 981 upgrades and 460 downgrades.
If you look at around 80% of these upgrades were the firms with low leverage and consumption and export linked firms, which is a huge shift towards one section of companies. Whereas of the total downgrade debt, which is about 2.4 lakh crores, about 90% belong to investment linked sectors, primarily from metals, real estate, and infrastructure. Now, coming on to the reasons for these upgrades. More than 2/3 of upgrades were primarily driven by business reasons, such as improvement in scale of operations, operating efficiency, primarily these two reasons. Whereas the another 1/3 was, more than 2/3 of upgrades were driven by business related reasons, such as healthy demand, improved operating efficiency, and scale of operations. Whereas 25% of upgrades were because of liquidity reasons. And a small percentage, 7% odd, was because of strengthening of balance sheets. In contrast, weak liquidity led to 60% of downgrades. Actually, 44% of downgrades were to defaults. And all of this, actually 98% of these, were primarily from BB and low rating categories, which are very vulnerable to default inherently. So this doesn't come as a surprise.
Taking off from what you're saying, so there has been a sharp focus on the performance of credit rating agencies recently because of instances of sudden and sharp rating actions, more specifically downgrades in the ratings A- and above. This creates an element of surprise. The sharp and sudden rating changes creates an element of surprise for the markets and leaves very little scope for the fund managers to handle their exposures. So very clearly at CRISIL, we have focused on maintaining quality of ratings and has strived to minimize the surprise element in our rating actions, especially in the higher rating categories. What has been the performance of our portfolio in A- and above in this first half? We have seen a very low intensity of rating changes. Out of about 1005 ratings in the A- and above space that we have in our portfolio, we have seen 55 rating actions. There are 30 upgrades and 25 downgrades. So 55 on a base of 1000, so which is a very low number in terms of changes in the ratings, which indicates very high stability of ratings in this category. Clearly something which investors expect from higher rating categories. They expect higher stability in the ratings. Also, if you look at the intensity of the rating changes, except for one rating action where there was an upgrade by 2 notches, all the other 54 rating actions were by only 1 notch. So very clearly it indicates that the intensity of our rating actions also in the first half has been on the lower side. Coming to the near-term outlook for credit quality and the trends that we expect, we believe that the credit ratio, which is upgrades to downgrades in terms of number of companies, will continue to remain above 1 in the medium term. meaning upgrades will far outnumber downgrades. However, when it comes to debt-weighted credit ratio, where you look at the debt and not just the number of companies which are being impacted by these rating actions, very clearly this will come in much below 1 is what is our expectation at this point of time, since the stress in the investment-linked and commodity-linked sectors is something which will continue for some more time. For a broad-based improvement in credit quality and systemic buoyancy to return to credit quality, very clearly what we will need to see is deleveraging in a meaningful manner of the stretched balance sheets of a lot of companies in the system. Significant improvement in the investment demand is something which will need to happen. And commodity prices is something which will need to hold up. The extent of interest rate reduction that will be done by the banks in the context of RBI cutting the repo rates is also a key monitorable. And finally, the government's ability to push through economic reforms in the current environment is also something which will play a key role.